Hey investor friends, I'm Michelle Markin. With the Fed looking to combat raging inflation with half-point rate hikes through September, you may be wondering if there's any safe place to hide to get a half-decent return on your hard-earned money, given how much turmoil the stock market is in and how inflation is hitting 40-year new all-time highs, where CPI inflation just hit 8.6% at the end of May 2022. And that may not even be the worst inflation we're seeing, because if you look at shadow stats, inflation could be as high as 16%. So given all this, I'm going to talk about how the United States Series I savings bond may be a really compelling place to invest money, at least depending on your time horizon and how much money you have to invest in something like that, and also compare them to high yield savings accounts. And for the purposes of today's video, I'm just going to rope in all the checking, savings, and money market accounts into one to compare how their interest rates are compared to the Series I savings bond. And so if you enjoy learning about the best ways to invest your money, I hope you'll consider liking and subscribing to my video and YouTube channel, and let's get into it. And so what is a Series I bond? Well, it's an interest-bearing U.S. government savings bond that gives a return to the investor based on a combination of a fixed interest rate and a semi-annual variable inflation rate. And I know that sounds like a bunch of word salad, so let me break that down a little bit. The Series I savings bond has a fixed interest rate of 0%, and also it's based on inflation. So depending on what inflation is, which is based on the CPI, which is based on inflation for urban consumers, that dictates what the inflation adjusted interest rate will be on the Series I bond. So inherently, it gives you no interest because it has 0% fixed interest rate, which is different from the Series II bond, which gives you 0.1%. But so if you have inflation going to zero or negative, then you may risk getting no return on a Series I bond. But with inflation raging lately, it's become really interesting since inflation has been higher than expected for a little while. So we're starting to see the inflation rate giving a decent interest rate on the Series I bond, because it used to be 7.12% as of November 2021 through April 2022. And it's gone up by another 2.5% to now 9.62% as of May 2022. And that rate will be valid through October 2022. So if you want to lock in a Series I bond that for the next 6 months will give you 9.62%, then that might be a pretty decent deal. But you can see that it will change, because after the 6 months are over that you've locked in with 9.6%, whether you buy it on July 1 or December 1, in the 6 months thereafter, the rate could totally change. And depending on where inflation based on CPI will be, it could either be up some more or down some more when the new rates come into play in November 2022. And also keep in mind that a Series I bond is a zero coupon bond, which means that you don't get paid out any interest during the life of the bond, but you get the interest paid out when you either redeem the bond, or if you wait and let it go to maturity, then you'll get all the interest plus your original principal back. And also the interest will compound upon interest. So whatever amount you earn through half a year, that amount becomes your new principal, and then you'll continue to earn the semi-annual variable inflation interest rate on that amount. So it's not a bad deal because your money keeps compounding semi-annually. So I think that that's kind of a decent bet right now, considering how much there's inflation going on. And with inflation still going up and not yet down, you could be pretty sure that you'll get a decent rate of interest back in the coming year, because if the interest rate changes every 6 months, then more likely it's going to stay kind of close to where we are now, unless the Fed raising interest rates demolishes inflation so much that by the end of this year, maybe inflation might go down a point or two, but I don't see it really going down nearly enough to knock off a pretty decent return for the next year on the Series I. So I'll tease out a little bit more of what that might mean, but essentially you're basically promised a rate of return plus some protection on the purchasing power of your money if you were to invest on a Series I bond. And to further illustrate how the Series I bond protects your money's buying power, if inflation really is at 8.6% and the current coupon rate of the Series I is giving you 9.62%, then you're essentially getting a real rate of return of 1%, which definitely is beating out most bank accounts, which at best are on average giving you maybe 1 to 2% nominal interest rates, which means that you're still losing at least 6.5 to 7.5% against inflation, no matter what. So to be able to get a real rate of return in this current high inflationary environment is something noteworthy, and it's probably beating the stock market since that's currently going in reverse. So for the next maybe 6 months to a year, it might not be such a bad deal. And also there are some caveats that you should keep in mind if you were to invest in a Series I bond, because as good as it sounds, it's not without some of its own limitations, where you have to own a Series I bond for at least a year before you can redeem it. And if you do redeem it before 5 years, there's a penalty where you're going to give up the interest of the last 3 months in which you held the bond. So that's something to factor in if you end up selling a Series I bond before the end of 5 years. And also the minimum that you have to invest is $25 into a Series I, and the maximum you can invest is $10,000 per year. And the good thing is that at least you can invest in a Series I bond at any time in the year, and then the clock resets as of January 1, and then you can buy 10,000 more. So as an extreme example, you could buy $10,000 worth of Series I on December 31 this year, and then on January 1, 2023, you could buy another $10,000. So even though you're buying a total of $20,000 within the span of 2 days, they're technically in 2 different years. So you're all good if you want to take advantage of getting some interest rates at current levels. And earlier when I said if you decide to sell these bonds, what I really meant is if you decide to redeem these bonds, because you would be doing that with the US government's Treasury Direct, and you could feel free to check out their website to learn all about buying and redeeming the Series I bond. And also a few things to keep in mind is that the maturity date is 30 years out. So if you decide to buy this bond in 2022, then you could potentially earn interest on it for the next 30 years through 2052, or unless you decide to redeem this bond sooner than that. And also, if you buy a Series I bond, they're sold at face value. So if you invest $1,000, you're paying $1,000 upfront to invest in that, because like I said, it's a zero coupon bond and you get the interest at the end, which you could decide to get taxed on that at the end of the total holding period of when you own it. So if you want to invest in this bond and not pay taxes on the interest, you could hold that until you decide to redeem that bond 5 or 30 years from now, or you could also pay taxes on each year of the accrued interest that you might get, even if you haven't redeemed the bond yet. So it's up to you how you want to get taxed on the interest that you get from these bonds eventually. And also, if we use an example of what you might get if you invest $1,000 in a Series I for the next 5 years, you would get a total of around $583 after 5 years if it compounds at the exact same interest rate of 9.62%, which isn't likely, but let's just pretend that you might get that amount every year, and that's based on a semi-annual compounding rate. So if you think about it cumulatively speaking, that's 58% after 5 years, or works out to about 11.7% per year, which definitely beats the average historical rate of return of the stock market at 7 to 10%. So it might not be such a half bad deal right now if we have inflation remaining high for the next few years. And just for informational purposes, to see how much interest we might be able to earn if we decided to invest in a Series I bond, let's take an example of investing $1,000, and with the current rate of 9.62%, that works out to a gross return of $96 for the year, and that works out on average to $8 per month in interest. But if we were to redeem this bond exactly 1 year after the minimum holding period, then we might be giving up the 3 months of interest if we didn't hold it for 5 years. So we have that penalty, and then that 3 months worth equals about $24. And so our total net return might only be $72, which gives a rate of return of 7.22%, which is about 2.4% below the total gross rate of return of 9.62%, and it's about 1.4% below the current official rate of inflation. So even though we're losing a little bit compared to what would otherwise be ideal if we could hold a Series I bond for at least 5 years, it's much better than some of the alternatives, which are a lot of bank savings and checking and money market accounts that are giving us still pretty low interest rates, since they haven't really raised rates all that much yet. And some of them, from what I've seen, are still giving minimum rates of return of something like 0.4 to 1%. And then there's a few that are giving sometimes a little bit too good to be true rates. So I don't really know if these are legit or not. So do your own research before you were to open accounts with them. But some of them are opening rates that look like they might give you 4 to 5%, which seems pretty attractive considering the flexibility of checking or money market accounts. And they have some caveats where sometimes you have to have direct deposit set up, or a certain level of transactions, or a minimum or maximum balance that earns that rate of return. But it could be ideal if you don't want your money tied up in something like a Series I bond for a whole year and you want to be able to take out your money whenever you need it. Then maybe opening a high yield savings or checking account could be ideal for you. And while we often hear about a lot of people bragging about earning the Benjamins, maybe if we invested in Series I bonds, then we could brag about the MLKs or Einsteins that we're holding in our investment coffers, and we'd be pretty happy to know that we're getting a pretty inflation protected rate of return, at least for a while, as long as inflation remains high. And so if you enjoyed this video or have questions for me, please let me know in the comments, and also please be sure to like and subscribe to my video and YouTube channel. And also I wish us all the best in not only surviving through inflation, but also ending up with much better returns on our money in the future. Till next time.